Who became a billionaire the quickest in history? While Warren Buffett took 55 years to become a billionaire, Jay Walker did it in less than a year. During the dot-com bubble, he launched Priceline.com and his net worth skyrocketed from zero to billions, but that wasn't sustainable because when the bubble burst, his net worth plummeted. Whereas Buffett remains at the top of the list and doesn't appear to be going anywhere anytime soon. That's the kind of wealth you want to create. Money is a difficult game to master. It's taut, competitive, and ruthless, and you're doomed to fail if you don't know the rules. Most people have the problem of working hard their entire lives, but ending up poor at the end because they don't know how to make their money make even more money. In other words, they have no idea how to invest. Assume you've been saving money and have $1,000 in your bank account. That is a significant accomplishment given that nearly 70% of Americans do not even have $1,000 in their bank account. So, instead of spending it on another useless gadget or a pair of shoes that you will wear once and then keep in your closet for many years before finally throwing them away, assume you are going to invest it. But the question is, where do you put your first $1,000? Do you put it towards real estate or the stock market? What types of stocks do you invest in? Is $1,000 sufficient to begin investing? We'll answer all of these questions and many more, so give the video a like and let's get started. Consider the following example to better understand what investing is and how it works. Let's say you worked really hard and saved $300,000. You could go to a Ferrari dealership and get yourself a luxury car to show everyone how successful you are. Or you could buy real estate, a house, and rent it out. You'll receive at least $2,000 per month. If you decide that you no longer want to receive that $2,000 paycheck every month, you can sell it and recoup your initial investment. In fact, the value of your investment may increase, allowing you to sell it for a higher price. And that is how money is made. However, real estate cannot be purchased for $1,000. That's not even enough for a down payment. However, that doesn't mean you can't put that $1,000 somewhere else and let it grow. The simplest solution is to deposit it in a savings account and earn interest. But why would the bank pay you to keep your money in the bank? Shouldn't they instead charge you? No. The bank, you see, will take your money and lend it to someone else at a higher interest rate, then share a portion of the profit with you. In a nutshell, that is how banks operate. The only drawback to this strategy is that the interest rate on the deposits account is so low that it isn't worth it. The best rate you're likely to get is 0.8%. That means that if you put $1,000 into a savings account today, you will receive an extra $8 in 12 months, which is extremely low because the Fed targets an inflation rate of 2 to 3%, which means that if you don't get at least 2 or 3%, the real value of your $1,000 will depreciate over time, allowing you to buy fewer goods each year. But why are deposit account interest rates so low? Because interest rates are generally low this year as a result of the pandemic, the Fed was forced to lower them, interest rates, to encourage everyone to borrow and spend. Once we are out of the recession, the Fed will raise interest rates to 1, 2, or even 3%. Which means savings account interest rates will rise as well. The other option is to purchase government bonds. A government bond is a financial security issued by the government to fund government spending. Say the government wants to build a school but lacks the funds, so it issues an IOU, a piece of paper that states that whoever owns this security owes the U.S. government this much money plus interest. Of course, this is an overly simplified example, but you get the idea. Government bonds are heavily influenced by interest rates, so because interest rates are extremely low this year, government bond rates are less than 1%. But 2 years ago, when interest rates were high, government bond rates were as high as 3%, which is not bad because government bonds are the safest investments you can make. Any investment carries some level of risk. What are the chances that the U.S. government will default on its loan? The entire U.S. economy may have to fail for the U.S. government to go bankrupt. As a result, U.S. bonds are regarded as the world's safest investment. However, if you want a higher return, say 10, 20, or 30%, you should consider investing in the stock market. Amazon's stock price, for example, has increased by more than 80% this year alone. Google's stock increased by nearly 30%. The stock of Tesla increased by 721%. You heard correctly, 721%. The question then becomes, why would anyone invest elsewhere when the stock market can double or even triple your money? Risk is the correct answer. Government bonds, for example, pose little risk. In fact, it is risk-free up to a point. However, when it comes to individual companies, there is a risk that the company will fail, report negative earnings, or otherwise cause the stock price to fall. The company may release a product, and if the public does not like it, this can result in some negative headlines, which can drive the price down, so higher returns come with more risk. Apple is a well-established company with fewer chances of failure than Tesla, but it also has less room to grow than Tesla, which is why Tesla grew by 721% this year, but Apple by only 70%. What you must determine for yourself is how much risk you can tolerate without going insane. If that is all you have left, perhaps risking it all isn't the best option, because if things go wrong, you could end up losing most of it. Investing in an index is one way for investors to reduce their stock market risk. The most well-known is the S&P 500, which tracks the top 500 U.S. companies. So an index fund would essentially invest in these top 500 companies. Some of these businesses will undoubtedly fail, but others will thrive. According to historical data, the average return rate for the S&P 500 since the 1920s has been around 10%. This means that purchasing a share of these index funds entails purchasing a tiny portion of the top 500 U.S. corporations. My three favorite index funds are VOO or Vanguard 500 Index Fund, QQQ and Index Fund by Invesco, and Fidelity Zero Total Market Index Fund. They are all fantastic and invest in nearly identical companies. But how do you invest in these index funds? I mean, where do you even begin? First, you must locate a broker, someone who is qualified to sell you stocks. Previously, you had to pick up the phone and call him to ask him to sell you some shares. Remember the Wolf of Wall Street? He'd spend the entire day calling people and trying to sell them worthless stocks. But thank goodness we're in 2020, and things are much better and easier. Brokerage firms, such as Robinhood and Webull, developed apps that allow you to buy stocks from the comfort of your smartphone. All you have to do is download one of these apps and sign up to begin investing right away. In fact, if you use the link below to open a Webull account, you will receive 2 free stocks. Please note that this is an affiliate link, but there is nothing wrong with that because you will receive 2 free stocks. Isn't that amazing? That is a good start, in my opinion. Check out the link in the description. I tried to make this video as simple as possible so that anyone who wants to start investing can do so right away. Often you want to start investing but have a million questions, so you start Googling this and that and eventually give up and try again a few months later. So I tried to answer all of your questions in this short video. So if you found the video useful, give it a thumbs up. And if you're new around here, hit the subscribe button and the bell next to it. Thank you for watching, and until next time.